This chart shows a brutal session for Indian equities today. The Nifty 50 shed roughly 600 points, slicing below the 23,200 mark, while the Bank Nifty took a steeper dive, losing over 1,800 points in a single day. The heaviest weight pulling down the banking sector was HDFC Bank. Shares of the lender crashed nearly 9% in early trading, immediately pulling peers like Axis Bank and ICICI Bank down into the red. Markets sell off on uncertainty, and the catalyst here was the abrupt resignation of part-time chairman Atanu Chakraborty. His departure statement explicitly cited that internal practices lacked congruence with his personal values and ethics. That specific phrasing triggered an immediate liquidation, wiping out roughly 1 lakh crore rupees in market capitalization today. However, historical data shows large-cap banks typically recover their footing and resume normal trading once the RBI approves a successor and governance clarity is restored. Until we know the specifics of those internal practices, the stock carries an uncertainty tax. Institutional buyers are sitting on the sidelines to wait out the volatility, preventing any immediate V-shaped recovery for the banking index. Compounding the domestic sell-off, reports of an Israeli strike on an Iranian energy facility sharply escalated Middle Eastern tensions. In response to the geopolitical strain, Brent crude oil surged past $111 a barrel. India imports the vast majority of its crude oil. When prices spike, it directly threatens domestic inflation, weakens the rupee, and heavily squeezes corporate profit margins across sectors like aviation and fast-moving consumer goods. Adding to the downward pressure, the U.S. Federal Reserve maintained a hawkish stance, signaling fewer rate cuts ahead than the market expected. Asian markets reacted poorly to the tightening liquidity, with Japan's Nikkei index dropping around 3%. Domestic banking fears, an external energy shock, and tight U.S. monetary policy converged today. This specific combination created a heavy, sustained market pressure, forcing the indices right through their major technical support levels. The Nifty 50's immediate floor sits between 23,000 and 23,075. If selling breaches 23,000, the index tests secondary support around 22,700. A deeper correction targets the 22,400 zone, aligning with the 78.6% Fibonacci retracement, a tool indicating support areas, attracting long-term institutional buyers. Meanwhile, the Bank Nifty is fighting its own battle. The primary support zone being tested right now sits in the 52,500 to 53,000 range. Hitting a numerical support level does not automatically guarantee a reversal. A genuine floor only forms when price levels align with a noticeable spike in buying volume and a measurable cooling of market volatility. Buying immediately into a steep drop carries heavy risk. Before attempting to catch a falling stock, wait for the India VIX to settle. The India VIX is a volatility index that measures the market's expectation of near-term price fluctuations. Until that metric drops, any quick upward move is likely a dead cat bounce. A dead cat bounce is a temporary, short-lived recovery in asset prices during a prolonged decline, followed by further downward movement. As the market tests these critical levels over the coming days, we will be tracking the price action closely. Subscribe to the channel and join our community WhatsApp group for real-time updates and structural breakdowns. Please note that I am not a SEBI-registered advisor, and the data provided in this video is strictly for educational purposes and market analysis. Sharp market drawdowns test investor patience. Surviving them requires a reliance on logical strategy, strict technical levels, and the discipline to prioritize data over emotional panic.